皆さんこんにちは。ピボットの野島です。本日のテーマは2026年のアメリカ経済テック展望と題しております。様々今世の中ではマーケットがバブルなんじゃないかという声もありますが、一体その実態はあるのか、ここをこの方にお伺いしていきます。今日はエンジニアとしてテクノロジーの現場を知り、投資家としても30年以上このイノベーションを見続けてきた方にお越しいただいてます。フランクリンテンプルトンのジョナサン・カーティスさんです。どうぞよろしくお願いします。Welcome.
Thank you so much.
Thank you so much for coming here. And could you briefly introduce yourself?
Sure. So my name's Jonathan Curtis. I'm the co-CIO of Franklin Equity. Franklin Equity is one of Franklin Templeton's very big investment teams. We do all sorts of investing, but I think we're experts in helping our clients navigate and understand and take advantage of complex, underappreciated change. Our team is headquartered right in the center of Silicon Valley, so we get tremendous access to the Mag 7 types of companies, but also many hundreds of recently public companies and private companies. I started my career as an engineer, so I'm a nerd at heart. I am a software developer by training, but I've been an investor for more than 20 years now. I co-lead the Franklin Equity Group, Franklin Equity, and then I'm also a portfolio manager on the Franklin Technology Fund. But we offer many of our interesting products here in Japan.
Interesting. So, how do you see the U.S. economy right now in just one word?
Yeah. Well, we think the U.S. economy is actually in pretty good shape. Inflation is under control. We think that growth is strong and potentially poised to accelerate in 2026. And that's going to be driven by really three factors.
Okay.
The first is there's a great deal of policy support. President Trump, when he came in, he enacted in partnership with Congress his One Big Beautiful Bill. And in that, there are incentives around tax aimed at reducing the level of tax for consumers, which should increase spending. But also there are incentives in place for accelerating capital investment, which we think is absolutely going to accelerate growth.
Okay.
So that's part one of the U.S. economy. But there's two other factors that I think that investors don't fully appreciate. The first is that the makers of artificial intelligence, these big model companies, many of the Mag 7 companies, are monetizing, selling artificial intelligence in a profound way and at a very big level and building massively in support of that. So the U.S. economy is getting growth and support off of that. But I think we're also starting to see companies in the technology sector, in the healthcare sector, in the financial services sector, and other knowledge worker intensive parts of the economy using these models to drive greater levels of productivity. We think those three factors are going to come together to help drive productivity growth and better than expected earnings growth in the United States in 2026. So we're bullish on the United States. There are many good places around the world to invest. We are positive on pockets of China, and Japan has interesting things going on. The United States is particularly interesting right now, specifically on the back of artificial intelligence.
Interesting. So I'd like to dive in more. So first of all, this AI bubble debate, is there a real ROI there?
Well, in a word, we do not think we're in a bubble. No bubble. This is the most important slide to look at. And for anybody who's watching or listening who is a knowledge worker, somebody who spends their time in front of computers, doing digital work, writing emails, writing software, building PowerPoint charts, this chart matters a great deal.
Okay.
It shows over time how these various models from XAI, OpenAI, Anthropic, Google have performed as the models have gotten bigger on various digital tasks, digital jobs. They took 44 different jobs in the economy, and then they gave the models these tasks. Build a spreadsheet, write an email, some complicated task. And as time went on, as the models got bigger, human beings preferred the outputs from the models. The models are getting better than the human beings at completing digital work. So as the models get bigger, they're getting better than us. So we think there is insatiable demand for intelligence and thus compute and for artificial intelligence. Now, I'm going to make one other very important point. And this is for all the knowledge workers who are wondering, when you see a chart like this and these models are now preferred over human beings, what does that mean for human beings? Anthropic put out a study a couple of weeks ago where they showed how these models perform on their own versus when they're partnering with a human being. Wow. And when they partner with a human being, they outperform the models when they're doing work on their own. So what does that mean? That means that human beings who are good at using these models are going to be very valuable, right? We're going to want more human beings that are skilled at using these models, right? Because you can get the best out of these models. The real edge is not the model. It is the human being in partnership with the model. So this is point number one, is that we're seeing these models starting to do economically valuable. This shows the number of users of OpenAI as a function of time and the output, the tokens, the number of essentially intellectual outputs from these models. And you see two things. One, you see an acceleration in the number of users over time. And you can see that quite clearly on the chart for the number of users. They're now at over 800 million weekly active users for OpenAI. But you see a very sharp acceleration in usage. Now, that sharp acceleration in usage came when they introduced reasoning capabilities into these models. Now, both of these curves look like exponentials to me. There's two charts here show the sort of the standard S-curve for technology lifecycle adoption. And the chart on the left shows the journey for cloud computing. So cloud computing is essentially a way to use computers and share computers that are far away from your enterprise, where enterprises no longer have to build their own computing infrastructure. When I became an analyst at Franklin Templeton in 2008, I covered the hardware companies, Dell, EMC, Cisco. And I recognized at that time that a new model for computing was coming. And I told all my portfolio managers, start buying the cloud computing stocks and avoid the hardware companies because big change is coming.
Right.
We made all of our money in cloud computing when we got up into the middle of that curve, when we got up on that accelerating part of the S-curve. Now let's fast forward to generative AI. We think we are down there at that third green dot for generative AI.
Right now.
Okay? Right now. We are just starting to ramp up that curve. So we do not think we are in a bubble. We think we are at the beginning of something truly profound. And we are seeing it first in software development. Software development is really the killer application for these models. We estimate that, I started my career as a software developer. So it is, other than investing, I kind of think of it as the highest form of knowledge work that there is. Smart people sitting in front of computers and designing complicated things with complicated codes, etc. About 9 months ago, all of the leaders of the major Mag 7 companies, many of them, Meta's Mark Zuckerberg, Satya Nadella of Microsoft, Sundar Pichai of Google, all said that they were getting a substantial portion of the software that their developers were writing directly out of these models. In some instances, 25, 30% of the code they were writing. Mark Zuckerberg of Meta said that by mid-year next year, they thought that these models would be good as any mid-level engineer in the company. Firms like Anthropic are now telling us that 90% of the code that their engineers are writing comes directly out of these models.
Interesting.
So if we can do that with software development, then I think we're going to start seeing those types of productivity gains in other knowledge work, in marketing, in finance, in healthcare, and I think that's going to drive a tremendous amount of productivity in first the U.S. economy and then broadly in the global economy. This is a simple framework that all of your listeners and your viewers can use to understand how big this might be.
Yeah, these are huge numbers.
Okay. We estimate that there are about 1 billion knowledge workers around the world.
Wow.
Okay. They earn on average about $50,000 US dollars per year. So that means annually, knowledge workers get paid about $50 trillion. And if generative AI is meant to augment or make knowledge workers more productive, then you can sort of think simply about, all right, well, how much more productive could we make a knowledge worker? 1%, 5%, 10%.
Yeah.
I already told you that software developers are well north of 30% more productive now. So how much could you make an average knowledge worker more productive? I use these models all the time. Before I came to see you, I sat down and used these models to prepare for my discussion.
Thank you.
When I'm reading my analyst's work, I'm using these models. When I am trying to figure out what's going on in earnings in the financial markets, I'm using these models. So I'm easily 10% more productive. That means that there's just at 10%, there's a $5 trillion recurring revenue opportunity. We've only spent a few $100 billion on data center infrastructure for generative AI. So no, we do not think we are in a bubble. This compares today versus 2000. And I was an engineer in
at that time, 2000?
In 2000.
Wow.
Working at a telecom equipment company. So I know what a bubble is.
Yes.
I know what it was like.
What was it like? What was that like?
Well, I got laid off. I lost my job.
Oh.
And most importantly, the industry had overbuilt capacity and there wasn't it wasn't being used very much. There was lots and lots of dark fiber, literally fiber optic cables that had been laid that wasn't carrying any traffic.
Yeah.
Today, there are no dark GPUs. There is a massive undersupply of compute. Now, there's other metrics you can look at. Free cash flow, margin structure, balance sheets. They all look better today than they did back in 2000. But here's another set of metrics here. This shows the Mag 7 of today compared with the Mag 7 of 2000. And you see two important things. One, the price to earnings multiple for the Mag 7 today, about 35 times forward earnings. But you get strong growth that we think is about to accelerate with 26% operating margins. Back then, you had an earnings multiple of 52 times on the Mag 7, so much higher, with nearly half the level of profitability. And the core input back in 2000 was fiber, and it wasn't being used. The core input today is compute, and it is absolutely being used. There's not enough of it. So we do not think we are in a bubble.
I get your point, but still, not everyone in the ecosystem looks profitable yet, right?
That's right. There are a number of companies, smaller mid-cap companies and private companies who are still investing very, very heavily and thus are not profitable yet.
And what about OpenAI? Like OpenAI looks burning cash right now and like turning to ads right now. So should investors worry about that?
No, I think it's actually very bullish that they're turning on ads right now.
Oh.
We know how to make internet platforms very big from a revenue perspective. And right now, OpenAI is dramatically under-monetizing their opportunity. And why is that happening? Because they're still learning how to navigate the market, what the use cases are. They're still gathering users. So there's a model that we use, a business model that we use in the early days of any big internet platform where you essentially give away the services to get users to learn about the use cases, and then you turn on monetization later. So what's the monetization that they can turn on? Well, they're already getting subscriptions from consumers. They're getting subscriptions from firms like Franklin Templeton. They have software developers paying them to use their models, but they're now starting to turn on ads. We know the ad-supported market is very, very big. Any company that has 800 million weekly active users is a valuable place to go place an ad, especially when the users are expressing economically valuable intent. I want to go on a ski trip. I need recommendations. I have to buy this. I want to buy that. Right? They're gathering lots and lots of information about us. So they can put ads next to that. The second thing they can do is pair up with e-commerce companies and sell things through OpenAI. And so they're doing that too. They're partnering with some of the big e-commerce companies in the United States, in Europe, and the like. So there's clear pathways to monetization. And we are actually investors in OpenAI. So we get to see some of their metrics before others can see them. And while we're under NDA with them, so I can't talk about the specifics of those metrics, I can tell you that they have a very viable plan towards profitability. We're comfortable with it. It tracks basically in line with off by a couple of years with what other key players are saying in the space. But we see a real path to strong profitability and a good business model for the company long term.
I thought market is kind of worried about OpenAI's running out of cash. That's why they're trying to monetize everything by doing the ads.
Well, I think they need to show that they can monetize. If they show that they can monetize, it will be easier for them to raise capital. And there are various media reports that they're out raising capital right now. But it is important that they show that they can show growth. But I see their metrics. The growth is very strong. The revenue levels are very high. No company in the history of the internet or in enterprise infrastructure has gone from effectively zero to the levels of revenue that they are at in the pace of time they've gotten there. And we're seeing the same dynamics for Anthropic, where we're also investors, and other model companies. So we're seeing good monetization, and we see a real pathway to a good unit economic business.
Okay, thank you so much. So if the returns are real, we have to look beyond the big techs, right? So much of the attention still on mega cap companies right now, but which industries see the earliest productivity gains from AI?
First and foremost, it's the tech sector. What did I say earlier? The killer app for these models today is software development. Software developers are being made very, very productive with these models, and we think it's going to diffuse out into other parts of the economy. So first, software development in these big tech companies. But these big tech companies are all at their core digitally native businesses. They have lots and lots of data about customers. They engage with their customers through digital channels. They are led by digital people. They have tinkerers throughout their business. So they are applying AI not just in software development, but throughout their businesses. I do not think that the markets are pricing the Mag 7 broadly correctly for the productivity gains that they're going to start delivering to us. So that's one area, information technology sector and communication services sector, where these models are being used. But secondly, we see big opportunities in other knowledge worker intensive parts of the economy. Financial services, healthcare. Jamie Dimon at JP Morgan has said that they see a pathway to getting $2 billion of savings from the usage of these models in their operations. In healthcare, there's stat that I think Sarah Fryer, the CFO at OpenAI, spoke about this at Davos. 66% of doctors are now using ChatGPT to provide better care to their patients, right? So we're seeing productivity gains in healthcare. I think we're going to see massive savings in the marketing channels of financial services and healthcare sectors, but also in consumer discretion, consumer staples sectors. I think we're going to see big savings in the back office of financial services companies, lots of paper and documents moving around. And in healthcare, you see that same dynamic. Lots of paper and legal materials to go through. We're going to see big, big savings there. So we are seeing savings already in financial services and in healthcare and consumer discretionary and consumer staples. The other opportunity sort of down the market cap spectrum from the Mag 7 are in the utility space. The demands for power running these data centers is very, very significant. And while these data center or these utility companies, both the regulated and unregulated companies, are getting pricing power off of this, we think that pricing power is going to increase as the available power on the U.S. grid is consumed. So there's an opportunity for utilities companies. There's also an opportunity for industrials companies that are helping to build that power infrastructure, helping to build the data centers and cool them. One metric that I think is interesting out of a Meta, Mark Zuckerberg has said they are building data centers that will cover the size of Manhattan. And that's just Meta. Amazon is building at similar scale. Microsoft is building at a similar scale. Google is building at a similar scale. And they've all said that, of course, they need the labor to support building those things. They need the industrial infrastructure to support building those things. But if they had more data centers, if they had more chips, they'd have more revenue because they are not constrained right now. There are, I think, real opportunities outside the Mag 7 in the knowledge worker intensive parts of the economy where these models are being used early, and in the industrial sector around the data center building and in the utilities sector.
Interesting. So there are a lot of like industries that are going to benefit from AI industry.
Absolutely.
But knowing what's real is very hard. Like, what company is the right place to invest in?
Yeah.
Right? How can we tell?
So I have a portfolio called the Franklin Technology Fund. We also sell a portfolio here in Japan called the Franklin Innovation Fund. And in those portfolios, we've got a long list of companies that we think are well positioned here.
Yes.
But I'll tell you how we do it.
Okay.
We are bottom-up fundamental investors. So what we do is we first go and figure out the big themes that matter in a market opportunity. And one of the big market opportunities right now is certainly artificial intelligence. And then we go study that theme and those companies that are in those sectors that we think are going to benefit. And then we literally meet with management teams. We talk with their customers. We talk with their competitors. We talk with their financiers. And then we use the tools of competitive analysis and evaluation to help us develop a sense of what the future might hold and ultimately what is an appropriate price to pay for that future that we believe is coming. But we are also in Franklin Equity very good at navigating complex, underappreciated change and ultimately trying to deliver transformational outcomes for our human beings. Do a terrible job thinking about exponential growth.
Okay.
But oftentimes, big growth opportunities, these S curves, are exponential curves. What human beings tend to do is they tend to model things out linearly. Well, if you model out the cloud computing opportunity linearly, if you did that in 2014, 2015, or if you do that today with generative AI, you just draw a straight line out, you end up at a very different place. You underestimate the opportunity. Human beings aren't good at this. So you need investors who are comfortable using the tools of growth analysis to really see these opportunities. So in 2000, this is a study done by Morgan Stanley. In 2000, the number of PC users was underestimated by over 36%. In 2000, the number of internet users was underestimated by nearly 60%. In 2013, 6 or 7 years after the launch of the iPhone, the number of smartphone users was underestimated by over a third. And the amount of cloud revenue in 2020 was underestimated by 22%. So Wall Street has a long history of making mistakes, but I think that being good at understanding how to model out and think about exponential growth is a skill and something worthy being paid for by active managers. So that's how we evaluate and understand where there is real value. We do that exactly that work I just walked you through.
About the valuation thing, I'd like to ask you one thing. What's the most important thing that you see in the company when you want to invest in the company?
Well, it all depends. There's not one most important thing.
Oh.
But in the case, I asked this question of the somebody at OpenAI. It was exactly this question.
Yeah.
And she said to me, the most important thing is revenue, right? Because revenue is the start. That means that you are getting a customer to part with their hard-earned dollars. He or she is getting value out of that. And then, of course, revenue has to flow across the whole P&L and ultimately result in earnings. So revenue is probably first and foremost. I would actually say in this case, first it's users, then users willing to pay or your ability to get economic value out. So that drives revenue. And then the next thing is that revenue flowing across the business model in an efficient way such that the unit economics, when the growth slows, reveals that the company will be very profitable in the long run. So we are looking at revenue, we are looking at users, we're looking at revenue, we're looking at unit economics, and then we're forecasting out to see if that ultimately results in a good business we want to own. We're also looking at competitive advantages, moats, etc. But revenue is, if you're asking me metrics, revenue is a pretty darn important one.
What about operating margin that you were mentioned that?
Very important. So unit economics is really the key input to operating margins. So unit economics is how much are you spending to secure a unit of revenue and what happens to that as that scales over time. If you're spending X to get a unit of revenue Y, and you keep that unit of revenue Y for a long period of time, and that ratio between how much revenue, that Y you're going to get over a long period of time versus the cost of securing and serving that revenue is a good ratio, then that implies that over time you're going to have strong operating margins. But importantly in growth investing, sometimes you don't want the operating margins to be high right away. You want them sometimes to be high in the long run. You want them to be low in the beginning because you're building a user base. You're learning about the opportunity. If OpenAI or if Anthropic or even Google weren't able to spend massively at the beginning of their lives, we would never have had these companies, right? When Microsoft started, they were not making money immediately, right? When Google started, they were not making money immediately. They had to invest, learn their markets, and then introduce and understand their unit economics and introduce more services to drive that margin. And now all those companies, certainly Microsoft and Google, are very high margin companies. So you don't always want operating margins to be high in the beginning. You want companies with good competitive advantages and good unit economics that you can see a pathway to strong operating margins over the long run.
Very convincing. Thank you so much. Okay. So the next question is, where the market hasn't priced this in yet?
Oftentimes, people look at the U.S. markets and they say, oh, the U.S. market's expensive.
Yes.
All right. And if you look at the blue line there, this shows the price to earnings multiple on the S&P 500. It's about 22 times. It's high relative to certainly recent history. That's dominated by effectively 7 companies, which make up more than a third of the S&P 500 index. I thought the Mag 7 were good businesses. And I think investors have figured out that these companies have a big revenue opportunity. They've not figured out the productivity opportunity. So I would argue that even the Mag 7 may be underpriced. But let's look at the rest of the economy, right? Let's look at the S&P 493, okay, which is everybody else, okay? So I can see the valuation of the S&P 493 by just looking at the equal weighted version of the S&P 500. Essentially, in that valuation metric, those 7 companies don't matter. They're just 7 of 500 companies, okay? So you're really seeing the valuation of the rest of the U.S. economy. And that's at 17 times earnings. That is not high. And it's not high, certainly if we're right, that 2026 could be a year of accelerating growth driven by the continued building and usage of AI, the productivity gains that come from AI, and the policy support. So I don't think the U.S. economy reflects that point of view. And if I'm right, then either that multiple is going to expand or earnings growth is going to do well, and we're going to see the U.S. markets do well. So I would encourage investors to be looking down the market cap spectrum at some of those smaller and mid-cap companies in the financial services sector, in the healthcare sector, where these models are first going to be applied to knowledge work, be looking in the industrial sector around the building of these models, and be looking in the utility sector where the power required to power these models will be there. That's where I see opportunity. We still own the Mag 7, many of the Mag 7. They're all good businesses. But as you look at how we've structured our portfolios, we're actually underweight the Mag 7. We're overweight these small and mid-cap companies. So we think what we're really saying there is that we think the returns, the investment returns, are going to be stronger for these small and mid-cap companies as our thesis plays out.
I don't know if it's possible, but could you share some company's name that you're looking at right now, or?
If I can come up with some examples of some good companies. I won't tell you companies we're looking at right now.
Okay, thank you.
But I'll tell you companies that we own that I think have good opportunities in artificial intelligence. We'll start with maybe a Shopify. Okay, they're a company out of Canada that helps to build e-commerce tools for small businesses. Okay, And this is not a recommendation of Shopify. We own it in our portfolio. It's publicly disclosed. You can go see that. But the leader of that company, he's a software developer at his core. He has made certain that they aggressively adopt artificial intelligence in all parts of their operations. And he's doing that because, of course, he's a software developer, so he has an intuition around the value these models are creating in his core workflow. But he also understands it's going to help to extend their competitive advantage. And that's exactly what we're seeing. The experience they're delivering for the users of the Shopify platform is very, very strong. So that's helping him attract new businesses to run on the platform and making those businesses on his platform more efficient, right? So that's an example of a company that's benefiting from artificial intelligence and that we own. Another company is Cloudflare. Cloudflare is one of the most important infrastructure companies on the planet. They protect, we estimate about 80% of the world's website and about 20% of the world's internet traffic. They provide website security services, network security services to companies, and increasingly cloud computing services powered by artificial intelligence. What's so interesting about Cloudflare, and again, not a recommendation for Cloudflare, we own it. It's publicly disclosed in our holdings. So I'm telling you about the company, not recommending it. But importantly, because they operate at the edge of networks close to end users, they're an ideal place to run elements of these artificial intelligence models. And we think that they're going to see a strong growth on the back of that unique architecture that they have. And this has been a big area of investment for them. I think there's also some debate in the markets right now about software companies. Many software companies, a Salesforce, a ServiceNow, investors are very skeptical of those companies because those companies, it's so easy now to write software. And I think what the investment community is missing is that these aren't just software companies. These are software as a service companies. They deliver a service, a high degree of reliability. They help you get value out of the data they've got on their platforms. They have all your users are trained on using them. They are very well positioned to use artificial intelligence, we believe, to extend and protect their moats and to lower their own cost of operation. We think those companies are profoundly those types of companies are profoundly misunderstood right now by the market.
Interesting, because like some people were saying that SaaS is dead, right? that were like so out of points.
I completely disagree.
Oh, yeah, okay.
The amount of SaaS software that we're going to see in the years ahead is going to explode. We're going to be able to write much more software at a much lower cost, and the existing incumbents who take advantage of artificial intelligence and the unique data sets they have and the strong reward signals in the user flows are going to use artificial intelligence to extend and accelerate their opportunities, drive down their costs, and accelerate their revenue growth. So I think that if you're a small company in a niche market or a new company that is trying to get started, you're going to have a hard time competing against those incumbents unless the incumbents aren't using it. The incumbents aren't using these technologies. If they aren't leveraging their advantages in distribution and in data, then those companies will have a problem. But I do not think SaaS is dead.
Thank you. It's very clear.
Okay.
So let's step back and look at the U.S. as a system. So how do recent policy changes support innovation right now?
The Trump administration is very keen on ensuring that the United States remains a leader in artificial intelligence. It has also got policies in place aimed at reshoring critical parts of global infrastructure. So the first thing they're doing is helping reduce the regulatory barriers to building more power infrastructure. And we estimate in about 3 years, the United States grid is going to run out of baseload power. So it is very important that we start building new power infrastructure now, and we make it easier for the hyperscalers to build. The second thing they're doing is they are, in part of the big beautiful bill, they are helping, giving tax incentives essentially through accelerated depreciation to encourage the building of manufacturing capacity, data center capacity now. And the earlier you build, the better off you're going to be. So that's another area of investment. The next thing they're helping with is rare earths. China has a real power over the globe in control of rare earths and the processing and delivery of rare earths. And if we want to have a vibrant ecosystem in robotics or even in semiconductors, we need to have rare earth capabilities in other places than in China. So the U.S. government is investing in rare earth infrastructure. And then finally, R&D tax credits has always been a big part of the U.S. economy. Those are areas of continued support for our innovators in the U.S. out of the administration and out of U.S. policy.
So like policy and technologies and everything is aligned right now.
Correct.
Okay. Correct. So let's talk about China again. How investors see China versus U.S. right now?
Yeah, I think investors are right to see the U.S. as a big source of innovation on the planet, but so is China. China's got has done amazing things over the past 25 years here. They have built incredible hardware companies. They've built fantastic automobile companies. They've created good competitive advantages in solar and EV batteries, and they built really good digital businesses themselves. So I think it is appropriate for investors to be looking inside of China. But one challenge in China is that policy is not always clear. The rules of the road are not always clear. So you have to be careful. And you have to be on top of things because things can change on a dime.
True.
And that can really hurt investors. But one area where I think we are confident that China is not going to change the rules of the game because they need to compete with the West and in particular the United States is around the development of artificial intelligence. And there's a number of private leaders in China, but the two big public leaders in China that we think are getting a great deal of policy support from the government, we think it's going to go on for a long time, are Tencent and Alibaba. So in the Franklin Technology Fund, which I'm part of managing, we own those two names. But China's a great place for innovation, but you have to be careful and selective. And so we've been very selective and picked two names to focus on.
Interesting. What about physical AI? I think they are developing so fast.
Yeah, I think China is doing a very good job in robotics. But I also think we're a long way from really solving the problem. The robotics and the physical labor market is actually, we believe, bigger than the knowledge worker market. So it's a very big prize we're going after. China has been focusing on it. The U.S. is also focusing on it. We've had robots for years. Japan knows about industrial robots, but they've all been dumb robots. They haven't had brains inside of them.
True.
So the critical unlock for physical AI or for robotics is the ability to put brains inside of these things that can navigate a complex and changing world and changing dynamics and solve real problems in the world. So I think China and the U.S. are very focused on this. Japan's very focused on this. But we have got to get world models built that understand physics. And then we've got to get these models these robots in and amongst us navigating the physical world, because there's all sorts of things to learn about that are beyond physics, right? What is an appropriate way for you and I to interact with one another?
Sure.
These robots need to learn those things. In Japan here, there's a very respectful thing that people do. I've noticed when they meet one another, they bow, right? Well, I don't know the appropriate way to bow, but once one robot learns how to bow, they will all know how to bow instantly. So what's exciting about these robots is it will take them a long time to sort of learn the basics. But once they learn the basics, they're all going to know them. They're going to be superhuman in many regards. So that's an exciting area for physical AI.
Interesting. What about the chip war? NVIDIA is known for the software environment CUDA, right? Do you think that there are some companies that are going to beat that environment?
There are other things that do compete with CUDA, PyTorch and others. What's so nice about CUDA is that it is used in a variety of applications. Many engineers know how to use it. There's example code around it. So I think CUDA's position will be strong. It'll be used for a very long time. But there's also just like there are multiple operating systems, Windows and Linux, BSD and the like, there will be multiple programmable environments for artificial intelligence. But there won't be thousands of them. There'll be a handful of them because developers cannot afford to go build skills in so many different environments that they have to pick a couple and then get really good at those. And so CUDA, I think, has secured its position in that regard.
The reason why I ask you this question is China is trying to replace the
of course
chips, right?
I'm certain that China will have their own version of CUDA, and it'll probably start building on top of things like PyTorch. But again, I think it's a mistake to say, either or. This opportunity is so big, and NVIDIA is so entrenched right now. There are many, but not thousands, of ecosystems will thrive, and China will likely have its own as well.
I see. So relative to other regions, including China, the U.S. is very strong.
I think the U.S. is very strong. I think China is strong. And now there are other parts of the world where innovation is not as vibrant. And so we don't invest as much of those parts of the world. But China and the U.S. are both very strong.
The next question is, what could slow this down?
Sure. Well, I don't think there's an issue with usage. I think investors are going to be surprised to the upside on how quickly these capabilities integrate themselves into our daily workflows. Software developers have had their entire workflow change over the past 2 years and meaningfully over the past month or so. And I think that same type of thing is going to happen in knowledge work. So what could derail this? We have a lot of physical constraints to get through. I said earlier in our discussion that in 3 years, we estimate that the U.S. is going to run out of baseload power. So we have power infrastructure to build. We have many data centers to build. We don't have enough engineering capacity to build those data centers. There's significant constraints on natural resources, water, copper demands, silver demands. These are all things that are solvable. Human beings are good innovators, and they will solve them. But any hiccups in that could slow this down. I think we're also watching very carefully the competitive dynamics, specifically for an OpenAI. Google is doing well now in the consumer part of the AI market. They've got strong competitive advantages around their own hardware. They've got good distribution relationships with browsers and with control of Android and their partnership with Apple. That could make them really powerful in the consumer AI opportunity. And that could make it more challenging for OpenAI to meet its commitments on deploying capital. So we need to watch that carefully. And I think that's why it's so important for OpenAI to start showing us their path to monetization. But you're also starting to see them shift a little bit more towards the enterprise market, where I think there is more of an open field for competition, new competitors to enter and be successful.
Those kind of problems could be much more of a bottleneck, but maybe it could be the major opportunity.
I agree. I think those bottlenecks in scarcity is opportunity and the need for innovation. And that's why I spoke earlier about the opportunities in the utilities sector and the opportunities in the industrial sector. Sure. As we try and get through these bottlenecks. But that also means that the core suppliers will have pricing power, right? And all these model companies have said, if I have more compute, I will get more revenue, which means they have pricing power right now in a constrained environment.
So what do we have to see in 2026 right now?
Well, I think we need to see the diffusing of these models into new workflows. I'm confident that is coming, but we need to see that happening. We need to see us navigate the building that has to get done and has been committed to get done. If that slows down because of bottlenecks or otherwise, that can be a challenge. We've got to get through the midterms in the U.S. I think the desire for policy uncertainty and drama is going to go down as the year goes on because President Trump, I think, is going to want to make certain that he goes into the midterms strong. So those are some things that I think investors are going to be watching.
Thank you. So next to the global supply chain, where do Asia and Japan, especially Japan, fit into this kind of supply chain that you were mentioning?
Well, throughout, I've been in Malaysia and Singapore. We certainly see some of the technology supply chain distributing itself outside of China and into places like Thailand and Vietnam and parts of Malaysia for building computers and the like. We're seeing some of it distribute certainly into the United States. Specific to Japan, I think they're very good in certain types of semiconductors and semi-cap equipment. We do have some investments in Japan in the semi-cap equipment space. So those are some things, and we're doing work right now on robotics and the like in Japan.
Thank you so much. Finally, for investors in Japan, so what message would you like to give them?
Well, certainly your own markets are in an interesting place right now. Opportunities expand globally, and certainly we're seeing flows into emerging markets and into other parts of the globe. Don't leave the U.S. behind. The U.S. is still...
I don't think they have.
Yeah, the U.S. is still a fantastic source for innovation. It's got fantastic policy support in 2026 that we think will support and maybe help to accelerate growth. It is the leader in artificial intelligence right now. And it is going to be one of the earliest places where artificial intelligence is employed. It is a knowledge worker intensive economy, services economy. So that leverage that we see coming from artificial intelligence is going to show up first in the U.S. And it's got some of the most flexible labor markets around the world. So the U.S. Should not be abandoned completely. It is a good place to still be deploying capital. And so hopefully investors take that out of it. But we understand the opportunities global. We talked about opportunities in Japan and opportunities in China and throughout Southeast Asia. So I certainly understand investors have many places to put capital.
Thank you. But just for the record, Japanese people love U.S. markets. So I don't think we'd have to worry about that. But the other thing is, if the U.S. economy dropped down, Japan goes down and down. That's what people say. So
well, yeah, we're connected and linked.
Yes, but pretty linked.
But yes, but there's some really interesting things going on inside of the Japanese economy right now, which I could see why somebody on the margin might want to bring capital back home or otherwise. But I would just say, just remember, the U.S. is a fantastic source of innovation, global stability, and leadership in innovation. And I think ultimately innovation is the path to unlock value and to sustain growth. And we are at a point of enormous innovation right now.
Thank you so much. ありがとうございました。
Thank you.
PIVOT では新たなメンバーを募集しています。特に営業と映像制作を担うメンバーを積極採用中です。募集の詳細につきましては概要欄の URL をご覧ください。ぜひ一緒に日本をピボットしましょう。